patience was a big thing. This is a less risky way if you do it the right way. So I'm just going to go and execute those shares. Stocks don't only go up. So that's the risk. Today, we're going to talk about options. What exactly are options? What's the point of them? How can they benefit you? How I got into them. Let me start with that. So the last couple of years, as you know, for investing has been challenging. Stocks don't only go up, and there is such thing as overvaluation, and we're seeing stocks fall right now. So for me, patience was a big thing. I was sitting on a lot of cash. I was doing some trading, but I also wanted to find a place where I could allocate a lot more capital to generate some pretty good returns that are especially learn it now, so that I can use it in the future when I'm fully vested. And that came in the form of selling options. So what exactly is the point of this? And what can they do for you? So I'm going to go over a couple of things today. Notice that I'm writing selling. This is a very important thing. Again, options gets a very negative connotation, especially with what went on in 2020, 2021, because people were just throwing money into options, not having an idea of what they did, and losing a ton of money. This is a less risky way if you do it the right way. So I'm going to go over selling puts and selling, and I should write in here, cash secured, and we'll go over what that means. And then selling covered calls. So these are the two main things that I'm going to hit today. Let's start with selling puts. So when you're selling cash secured puts, what your idea is to get assigned shares that you want at lower prices. And I'm going to use Apple as an example. So I'm going to pull up here an options chain. And if this options chain looks confusing to you, don't worry. This literally took me sitting over there with somebody teaching me. They had to run through it 4 or 5 times because this can be counterintuitive. Don't get overwhelmed right off the rip. So let's say that we want to buy Apple shares. Currently, the price of Apple is sitting at $130. And we'll just say it's $130 on the nose. I don't want to buy Apple shares there. I want to buy Apple shares around $100. So what am I going to do? Instead of me waiting, just sitting and doing nothing and saying, okay, well, I'll set an alert and when it hits $100, I'm just going to go and execute those shares. Well, instead, I'm going to go and sell what's called a cash secured put. So I'm going to go to a date in the future and I'm going to write a contract with the market. So let's go to the date of March 17th, 2023. And I'm going to come down here and I'm going to highlight it with my cursor. And we're looking at $100 on Apple. So the principle here is that we want to be assigned Apple shares at $100. I want to make this caveat. Do not go and do this on companies that you do not want to own. For example, I'm not going to go to something like Plug Power, for example, or Neo or something like that and sell a put because I'm going to get some type of good premium, which I'll explain what premium is in a second. You need to sell shares at prices that you are comfortable owning the stock, because if I get assigned shares at $100, I better want them. And that is why this strategy is less risky. You would be, let's say that Apple goes to $75. Well, that sucks that you lost $25 because you're going to get assigned those shares at $100, but you are going to go in your profile and enter shares and buy them for $100 anyway. So it really, that's where the risk, lessening risk happens. So let's go, $100 here. Now, what is the point of this? Well, right here, you are going to get about $1.22 per share. So to write this contract with the market, you're going to get $1.22 per share for the expiration date of March, let's go 3/17/23 at $100. So what happens if Apple hits $100 on this date? If Apple hits $100 or anything less than $100 on the nose, you will get assigned Apple shares at $100. If Apple goes to $95, you're getting assigned shares at $100. If Apple goes to $50, you're getting assigned shares at $100. So that's the risk. But you were going to buy it $100 anyway. So that's where that risk kind of goes away. Now, why would you do this? Well, instead of you going in and just buying shares at 100, maybe in March, what are you doing? You're collecting an extra $1.22 per share. If Apple, let's say Apple finishes at 110, or let's say it stays where it is at 130. Well, this contract is just going to expire. You're still going to collect that $1.22, and you can rewrite your contract. You can go home happy. You can rewrite it at a lower price. You can rewrite it at a higher price. The contract expires on this date. Now, is there a way to exit them early? Yes. I'm not going to explain that in this video, but we do a ton of those types of videos. I have a full series on it in the Oracles of EM chat. So the point behind selling options, selling cash secured puts, is to collect a little bit of premium while waiting for your stock. So getting that, and each contract, one contract, equals 100 shares. So the cash secured part comes into play. you need to be able to buy 100 shares. So you need to buy 100 shares, be able to buy 100 shares of Apple, or you're going on margin, and that is not something that I encourage people to do. So that's on the put side. That's while you're waiting for stocks to come down in price, stocks to get cheap. And I have a lot of puts out there. I'm right on this side. I have Micron, Google, Meta, Alibaba, Tesla, even Tesla, Nvidia, Microsoft, Intel, Apple. Now, what do you do if you own shares? Let's say you own shares of Apple and you really want to get rid of those Apple shares, but you don't want to get rid of them until the strike price hits, let's call it $170. You're comfortable exiting your shares of Apple at $170. So let's say you own them let's say you bought the shares at $50. You're going to make $120 per share. Good job. And you will be a happy camper. So what you're going to do is come in here in the calls section, and you're writing covered calls. And the reason they're called covered calls is because you are covering a position that you already own. And the idea is that you're comfortable selling those shares at whatever you determine your strike price is. So right here, we're going to go to the same date, March 17th, 2023, and we're going to look at the $170 strike. Now, what is the advantage here? Well, looking at this, Apple is currently $130 a share. It's $40 away from its strike price. Is that going to happen by March? We don't know. But if it does happen, you're okay losing those shares at 170. So what you're going to get in that time period is about 37 cents. So let's say you have 300 shares of Apple. Well, you can write 3 contracts, because remember, one contract equals 100 shares, so 3 contracts, and you'll get 37 cents per share. So 37 cents times 300. And that's what you're going to collect. And remember, now let's go through what happens. Let's say that date comes around. So 3/17/23. And let's say that Apple is at $140 a share on that date. What happens? You keep your 37 cents. Contract expires. Everybody goes home happy. Well, except for the person you wrote the contract with, because they had to give you 37 cents. Now, let's say that Apple's shares get to $170 on the nose. What's going to happen? You are going to be forced to sell those shares. They're going to take them out of your account at $170. Let's say that Apple goes to $190 by that time. What happens? They are taking those shares away from you at $170. So what's the risk on covered calls? The risk is opportunity cost. You can still lose those shares at 170 even if the stock price goes to 190. Is there a way to exit them early? Again, yes, there is, but I'm not going to go over that in this video. But the risk on covered call side is opportunity cost. So this was just a very quick and basic look into what options are and how you can pull them into your portfolio. The question is often asked, how much money do I need to be able to play with options? Well, you've seen, because you have to have 100 shares at a time, there are different ways that you can do it with quote unquote poor man's covered calls and whatnot. But to do the method that I teach, you need to have a little bit of money to be able to do this. Now, I'm going to give a caveat to that. I encourage you to learn this now. If you're watching this channel, you clearly understand a little bit of what's going on, and you're probably going to have some wealth in your future. Instead of having $100,000 in a couple of years and saying, oh no, what do I do with this 100,000? Learn the process now. This is a teaching platform. Learn it now and be able to develop yourself and adapt. And when you do have that 50,000, 10,000, 100,000, whatever it is, you can hit the ground running. So guys, if this is resonating with you and you want a little bit more in-depth understanding kind of what these Greeks mean, a little bit different, a little bit more in-depth, a little bit of understanding how to exit those options early, how they can better benefit your portfolio and your family, come and join the Oracles of EM. I have a series on options. You can ask me constant questions on it, and there are tons of people that do this every single day and make money for their families. You guys have a great day.